What happens when oil surges 13% in a single day? When missiles strike near one of the most critical shipping routes on Earth? When the Strait of Hormuz, the artery of global energy supply, suddenly becomes a risk zone? And at the same time, Bitcoin begins to react. Is this the start of a deeper correction below $60,000? Or is the market setting up for a classic bear trap before the next major rally? Today, we break down the geopolitical shock, the oil market reaction, and what this could mean for Bitcoin, based strictly on macroeconomic mechanics, historical patterns, and observable market structure. Global financial markets were shaken after reports confirmed that U.S. and Israeli military strikes targeted sites inside Iran amid escalating tensions in the Middle East. Oil markets reacted immediately. Brent crude surged roughly 13%, climbing above $82 per barrel, its highest level in months. Energy traders rapidly priced in geopolitical risk. The reason is simple: supply uncertainty. At the center of that uncertainty is the Strait of Hormuz. This narrow waterway connects the Persian Gulf to global markets and carries roughly 20 to 30% of the world's oil supply. It is one of the most strategically important shipping routes on the planet. Any disruption, even temporary, creates ripple effects across commodities, currencies, equities, and cryptocurrencies. Following the escalation, shipping activity slowed. Multiple vessels reportedly paused transit due to rising security concerns. Major shipping companies reassessed operational exposure in the region. Even precautionary pauses can increase volatility. Markets do not wait for confirmed long-term disruption. They price fear immediately. At first glance, oil and Bitcoin appear unrelated. Oil is a physical commodity powering the global economy. Bitcoin is a decentralized digital asset. But the connection lies in macroeconomics. When oil prices rise sharply, transportation costs increase, manufacturing becomes more expensive, consumer goods prices climb, inflation pressures build. Rising inflation expectations often force central banks to remain cautious. That typically means tighter liquidity conditions, and liquidity is one of the most important drivers of risk assets. When liquidity tightens, speculative capital often pulls back from equities and cryptocurrencies. In recent years, Bitcoin has increasingly traded like a macro-sensitive asset during global stress events. When markets shift into risk-off mode, volatile assets tend to experience selling pressure first. Historically, geopolitical shocks follow a familiar pattern: initial headline shock, rapid risk-off move, liquidity recalibration, then stabilization. We appear to be in the initial shock phase. Following the first wave of geopolitical headlines, Bitcoin saw downside pressure, retracing from higher levels towards short-term support zones. Volatility increased. Leverage began unwinding. Derivatives markets adjusted funding rates. This is typical behavior during sudden macro uncertainty. Importantly, there is no confirmed structural breakdown in Bitcoin's broader trend at this stage. However, short-term risk levels have clearly risen. Several financial institutions have suggested that if tensions persist, Brent crude could trade in the $80 to $90 range. If oil sustains above $85 per barrel, inflation expectations could rise, bond yields may increase, the U.S. dollar could strengthen, and risk assets could face continued pressure. That environment can be challenging for Bitcoin in the near term. However, it is also important to recognize that geopolitical oil spikes can reverse quickly if supply routes remain open or tensions ease. Markets often overshoot during panic phases. Let's consider possible scenarios. If tensions de-escalate quickly and shipping through the Strait of Hormuz remains largely operational, oil prices could retrace. In that case, risk appetite could return, and Bitcoin may attempt to reclaim higher resistance levels. Reclaiming the $72,000 region would be technically significant. A strong move above that zone could attract momentum traders and open the path toward the $80,000 to $83,000 range. If tensions persist for several weeks and oil remains elevated above $85, inflation concerns may linger. Equity markets could weaken and crypto markets could remain under pressure. In that scenario, Bitcoin may test the psychological $60,000 support zone. A breakdown below $60,000 could trigger stop-loss activity and short-term liquidations. However, historically, sharp corrections during macro stress have sometimes formed strong medium-term accumulation zones. In a more severe escalation scenario, where supply disruption becomes prolonged, oil could move significantly higher. That could push global markets deeper into risk-off territory. Under such conditions, Bitcoin could experience a deeper correction. But even then, Bitcoin's long-term trajectory remains heavily influenced by global liquidity cycles rather than short-term geopolitical headlines alone. From a derivatives perspective, current positioning shows increased hedging and rising implied volatility. This suggests traders are preparing for a larger directional move. Some market participants are discussing the possibility of a bear trap. A bear trap occurs when price temporarily breaks below key support, triggers panic selling, and then sharply reverses upward once liquidity is absorbed. If Bitcoin manages to decisively reclaim the $72,000 resistance zone, bullish momentum could return quickly. Until that happens, caution remains prudent. Beyond oil, markets are also watching U.S. inflation data, Federal Reserve policy signals, bond yields, and dollar strength. Bitcoin now trades within a broader global macro framework. It is influenced by liquidity conditions, monetary policy expectations, and cross-asset correlations. If oil-driven inflation pressures delay potential rate cuts, that could create short-term headwinds. If inflation stabilizes despite energy volatility, Bitcoin could recover more quickly than many expect. It is also important to separate headlines from confirmed structural impact. There is no verified evidence at this stage of a prolonged total shutdown of global oil flows. Shipping slowdowns and security reassessments reflect elevated risk, but markets may be pricing worst-case scenarios faster than fundamentals are changing. This distinction is critical. Financial markets move on expectations first, facts later. For Bitcoin, key levels to monitor include support around $63,000 and the psychological $60,000 zone on the downside. On the upside, the $72,000 resistance region remains a critical pivot. A sustained move above it could shift sentiment significantly. The surge in oil prices following U.S.-Israel strikes on Iran has introduced fresh macro uncertainty into global markets. The Strait of Hormuz remains the central variable to watch. If tensions ease, Bitcoin could stabilize and recover. If oil continues climbing sharply, pressure may persist. But Bitcoin has navigated global pandemics, inflation shocks, monetary tightening cycles, and geopolitical conflicts before. Short-term volatility does not automatically invalidate long-term structural trends. Right now, markets are recalibrating risk. The next decisive move in Bitcoin will likely depend not only on crypto-specific factors, but on how energy markets, inflation expectations, and geopolitical developments evolve in the coming days. In periods like this, patience matters. Watch liquidity, watch oil, watch key technical levels. Because when macro shocks hit global markets, Bitcoin rarely stays quiet for long.